Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Tuesday, the 25th of June 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so I hope that the sound check is good. All right, okay, excellent. So now, before we jump straight into the short-term technical outlook on the various broad-based cross-asset classes, ranging from the major US dollar pair, the major stock indices, and as well as the two key commodities market, that is gold XAU/USD, as well, and lastly the West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of the release of key respective news flow, as well as the cross-asset price performance. All right, so let's start with the US stock market first. So over the US stock market over here, what we could see at this juncture yesterday was the underperformance, the continuation of the underperformance of the Nasdaq and the S&P 500. For those who have followed our daily dose of market insight yesterday, that couldn't be a major surprise. Why? Because yesterday I do covered that this potential bearish break of that 19,700 short-term support on the Nasdaq 100 because of a very appearance or the emergence of a weaker short-term technical picture in NVIDIA. So yesterday's culprit or the trigger point within our expectation that triggered that intraday sell-off in the S&P and the Nasdaq 100 was primarily caused by NVIDIA. Why we look at the Nasdaq 100 is down negative 1.15%, the SPX is down negative 0.31%, as we know that the Nasdaq is heavily weighted towards a higher technology component stocks, and NVIDIA has a significant influence on that. And while the Dow Jones Industrial Average and the Russell 2000 managed to outperform because the cyclical, I'll call it the rather cyclical and financial stocks managed to actually outperform yesterday within the US stock market. So the Dow Jones is up 0.67% and the Russell 2000 is up 0.43%. So if you look at the heat map of the S&P 500, that actually explained to us the reason why S&P and the Nasdaq 100 actually underperform, because of this heavy weighted semiconductor sector inside the S&P 500 and within the Nasdaq 100 as well, that is clearly underperforming yesterday. All right, so what we could see, the entire market, there's actually more green than red. The only fact that why S&P underperformed because of the huge market cap weighting on the semiconductor stocks, especially NVIDIA, that is dragging the S&P and the Nasdaq 100 down. So overall, if you could ask me, is it the start of a very much more significant corrective sequence for the US stock market? That means, i.e., looking for a 15% to 20% decline, somewhere similar to the late third quarter of last year? My answer to you right now is low probability. Why? Because the wider market is still in a bullish trend. That means, i.e., yesterday's sell-off in the Nasdaq 100 and the S&P 500 has not spread into the Dow Jones and the Russell 2000 yet. And one of the reasons why the Dow Jones Industrial Average actually outperformed yesterday is due to its heavy weightage in Goldman Sachs, which is one of the key financial stocks that actually saw the financial sector outperform yesterday, relating to a positive news flow that the Federal Reserve right now is actually engaging with the banking or the financial US services sector in the US, because right now the Federal Reserve, previously at the start of this year, they wanted to actually have the US financial services firm, especially the banks, to deposit much more safety capital with the Federal Reserve to prevent another potential Silicon Valley bank run-like scenario that to take shape. But however, there's this ongoing flow of debates between the commercial banks, especially those investment banks in US with the US Federal Reserve, stating that if they were to actually put in a huge safety buffer with the Fed, that could increase borrowing costs in the wider US economy, which eventually will cause a negative impact in US economic growth. So after this slew of ding dong of debate between the banks and the US Federal Reserve, the US Federal Reserve decided to tone down this so-called safety buffer capital height that was initially being imposed on the US banks. All right. So what I will do over here is that the Federal Reserve has shown that other regulators at a 3-page document possible changes to their bank capital overhaul. So this will significantly lighten the load on Wall Street lenders, especially on banks trading businesses. All right. So that actually also impact banks that has a significant investment banking operation, some like JP Morgan and Goldman Sachs. So you see yesterday, JP Morgan and Goldman Sachs actually also outperformed, all right, within the financial services sector. So JP Morgan is up 1.31% yesterday, and if you look at Goldman Sachs as 2.65%, given that the Goldman Sachs primary revenue still comes from investment banking, while JP Morgan do have a sizable portion from commercial and consumer banking as well. So net overall, that actually causes the Dow Jones to actually outperform the S&P 500 and the Nasdaq 100 due to the outperformance of the US financial stocks. And given that the US financial stocks has a significant, much more heavy weighted inside the Dow Jones Industrial Average. So for those who, I believe that previously I did share in one of my daily dose, for those who want to find out the Dow Jones Industrial component, because in order to find out that, you need to have access to the S&P 500 company that's now part of Dow Jones, who does the compiling on the daily basis. So there's a particular website that is free, but it has about 1 to 2 days of delay, but that should be good enough for us to find out what are the key component stock inside the major US indices, including the Dow Jones Industrial Average. So you can go this one called slickcharts.com, as in SLCK charts, then CHART.com. So you go over here. So you can look at this S&P 500. So you look at companies, they will give you the component stock within the S&P 500 and its respective weight. So let's say if you go to the Dow Jones Industrial Average, you click on company, you're able to see it rank accordingly. Okay, being the top one by weightage and its respective weight over here. And don't forget, the Dow Jones Industrial Average is weight according to price rather than market cap. So it's slightly different from the weighting methodology of the Nasdaq 100 and the S&P. So I could see that the Goldman Sachs was the second largest weighted market cap on top of this healthcare stock, United Healthcare. So that's the reason why the Dow Jones outperformed yesterday, due to this more than 2% rise in the Goldman Sachs share price, due to that positive news flow of that potential lesser safety buffer capital that the bank need to deposit with the Fed, potentially going forward in this ongoing negotiation. All right. So now, with that, let us now take a look at other news flow that is impacting the overall market. So what we could see over here is that yesterday, there's this kind of more or less confirmation that we now start to see this trade tension, not between US and China, but spreading to the other G7 airlines with the US. So now Canada right now is more or less in favor of curbing China EV export to Canada. Okay, so this actually in response to the US latest, we call it, put in a way that latest proxy trade war that is being fought with China in the upcoming US presidential election. So Biden right now, in order to win the popular vote, he's now getting more like a strongman-like characteristics, very much similar to Trump, advocating a bit of protectionism policy, American first policy, and the unfortunate punching bag is China right now. And what Biden and Canada claim, China is flooding the world with very, very cheap, unfair price we call it advantage in their EV export towards the rest of the world. So what Canada did over here is that they actually right now looking for a, I think, close to 30% hike in their so-called Chinese export to EV exports to Canada. So right now this is only EV. So as the months goes by, that could actually widen up to other related Chinese products as well. Potentially, if we start to see this situation kick off. So what we could see over here is that given this, we call it a heightened trade tension, not even in US towards China and towards against the G7 and China, that actually doesn't gel well to China stocks as well as its proxy, which is the Hang Seng index. So if you look at the Hang Seng index, it's going to trade rather a lackluster situation in the near term. All right, so now that will be the key important data. And one more thing to highlight over here is let's take a look at the Fed speak yesterday as well. So yesterday we have one key official speaking, Fed Daily. She's the voting member of this year FOMC board. That means she has a say in the directional or the level of the Fed funds rate. So I will say that yesterday's speech from her is rather balanced, because she did mention that inflation is not only the risk at this point, she's also looking at a further cooling in the labor market that could drive up unemployment. So if that's happened, that could allows the Fed more evidence to enact their first at least an interest rate cut in 2024. So towards her speech over here, I would say that it's a rather balanced speech. All right. Okay, so and then say if inflation falls more slowly than expected, it will be operate to hold rates higher for longer. All right, so eventually at the end of the day, and if inflation falls quickly or the labor market cools more than expected, cutting rates will be necessary. So at the end of the day, her stance is much more data dependent. So they are taking things one step at a time rather than giving a very strong guidance to be hawkish or to be ultra dovish. So if you look at after her speech yesterday, a public speech yesterday, there is no change in the pricing of the expectation on the upcoming Fed funds, we call it a hike or cut trajectory as being priced by the Fed funds futures market, compiled by the CME Fed Watch 2. So if you look at the probability over here, the accumulated probability, at this point in time, the Fed funds rate is 5.25% and 5.5%. So potentially July will be a no change again, because market is pricing 89.7%. And the first cut is still rather high in terms of odds. 61% chance as being priced by the interest rate futures, the Fed funds interest rate futures, to bring it down to 5% to 5.25%. So it's rather high, it's above 50. Then thereafter, on the whole again for November, and we do see only a very a small chart about 50% chance, because it's put 45% to 21% is 60+%. So if you look at the accumulated one over here, because this one they break down according to non-accumulated. So if will bring down the aggregated one or the accumulated one, this gives us a better view. All right, so 89% chance no change at the July meeting, 74% chance of a potential cut coming in the September meeting, then we hold on November, and 90% chance of another cut before the year's end on the 18th of December 2024 meeting. So the trajectory of the US Federal Reserve rates at this point in time is still pretty much data dependent, and based on the current pricing, market is still looking at 2 interest rate potential cut before 2024 ends. So that also explained to us at this point in time in the short term why the US 10-year Treasury yield is still hovering on the softer side of the story, below that 200-day moving average and below that 50-day moving average. All right. So right now, with that, let us now take a quick look at the intermarket dynamics. Okay, starting with the US 10-year Treasury yield. Okay, so if you look at the US 10-year Treasury yield over here, okay, this is the starting this. Let me do the 10-year first. Okay, so the 10-year going to trade very lackluster on the softer type of the story, like I explained earlier, due to that Federal Reserve Fed funds pricing that is still looking for potential to interest rate cut below the 200-day and the 20-day moving average. All right, and also one potential reason why the US Fed fund, US Treasury yield is also on the softer side. Don't forget, if Treasury yield goes down, that means US Treasury bonds prices increase. So US Treasury bonds is also being used as a safe haven instrument in terms of rising risk tension, like geopolitical risk tension. And we know that the upcoming geopolitical risk uptick is over these results of the first round of the French presidential, not presidential, the France local parliamentary election, pardon me, that going to be held on this Sunday, and very likely it's going to be in the margin is actually favored the right-wing Le Pen National Rally Party. Okay, so that will explain to us why a bit of political uncertainty or political risk premium that is coming out from this upcoming French election, that is actually increasing the safe haven demand of treasury bonds. So it increased the treasury bonds price, which also eventually put down softness or downside pressure on the US treasury yield that is below the still trading below the 200 and the 20-day moving average since last Wednesday. Okay, since 2 weeks ago on the 12th of Jan, pardon me, 12th of June, not Jan, 12th of June. All right. So very similar movement also on the shorter term end on the 2-year. Okay, that is also getting very trading below that 200-day and the 20-day moving average. So right now, with this ongoing softness in the 2-year treasury, the 10-year and the 2-year treasury yield, it do have a bit of impact on the US dollar index as well. So given the fact that the US dollar is also considered as a safe haven FX asset during a geopolitical risk tension, which I explained earlier, this political risk uptick that is coming out from the Eurozone due to the upcoming French localized parliamentary election. So what we could see over here is that now the US dollar seems to be fighting in a tug of war. Lower US Treasury yield on one hand also could cap US dollar strength, but due to that safe haven bids coming to rising geopolitical risk or a geopolitical risk factor due to that political uncertainty surrounding the France localized parliamentary election this coming Sunday, we start to see that dollar strength giving a bit of pullback after last week uptick from the bounce of the 20-day, 50-day moving average. So what we could see over here is that it seems to us that this dollar index here could start to be in a tug of war at this point in time, at least in the short term, between the 106.37 resistance level. So what is 106.37 level is in fact the descending trend line that I linked from the high of 3rd of October last year and the medium term swing high of 17th of April and 30th of April. And the near term support level to watch will be the 20-day moving average that is acting as a support at 104.90. So it seems to be that there will going to be a tug of war between 104.90 and 106.37 going forward, at least in the short term. So what we could see over here is that means in the short term perspective, that means on the intraday perspective, there could be no clear a strong trending condition between the dollar major pair. That means they're going to be trapped within a certain range, and some part of the day during the intraday on the intraday basis, that means today it could be bullish, tomorrow it could be bearish again. That means it will be a swing. Okay, it will be a swing move within this put it in a way that within fighting against conflicting factors. Lower US Treasury yield due to its traditional intermarket or normal under the normal circumstances, excluding any geopolitical risk premium, it could lead to a lower US dollar. But now, right now, because of a potential uptick in geopolitical risk premium, the US dollar could also see bids coming in because the US dollar is also considered as a safe haven asset class in terms of such uptick in geopolitical risk premium. So that could be a tug of war, all right, in the short term. This is what my expectation. All right, so right now there's also one intermarket correlation that I want to share about. Is more related to the Nasdaq 100, but that I will actually covered when I touch on the intraday technical outlook on the Nasdaq 100 thereafter. All right, so with that, now let us now jump straight into the various respective short-term intraday technical outlook on the cross asset classes, starting with the FX market first. All right, so before that, let me expand my screen so that you guys could see much clearer. So let us start with the euro dollar. All right, so given the fact that yesterday euro dollar it actually shaped a bit of positiveness. So yesterday we do have a bearish bias looking for it to actually re-expose the medium term range symmetrical triangle ascending support level at 106.56, but however price action burst up and it broke above the descending trend line that I drew from the high of 7th of June that has been capping prices down since 12th of June, and as well as most recently on last Thursday. So yesterday break of this level and it starts to bounce of it, seems to us that short-term momentum is coming back, as well as also being depicted by the US dollar index showing some form of hesitation below that resistance level. So with that, even though it still remains below that 10750 short-term pivotal resistance that I highlighted yesterday, due to this positive intraday technical we call it condition that has surfaced in the euro dollar, I got to respect the latest price move, and we will flip to a bullish bias condition for today on the intraday basis. I would stress, because it's an hourly chart, for sure the first support level to watch will be this pullback level over here. Okay, the pullback of and the retest of that former descending trend line now turns into a pullback support at 107.20. So I'll use a slightly lower level at 106.95. So 106.90, as long as the pullback didn't surpass below 106.95, we will flip to a short-term intraday bullish bias above 1075, exposes this extension of this minor bounce scenario to unfold. Next resistance to watch will be a bunch of moving average, the 20-day and the 200-day moving average, conferencing at the graphical resistance zone of 1077.0 slash 107.90 above, potentially revisit the minor swing high of 13th of June at 108.15. Only an hourly close below 106.95 will invalidate today's intraday bullish bias to see it floating down to retest the key medium-term support of that lower limit of that symmetrical triangle range support at 106.56. Below it exposes 106.20 and 106 figure level, which is the minor swing low of 16th of April and 17th of April. Now, with that, let us move on to the sterling dollar, the cable. So the cable also shaped very similar price configuration as well. Now, breaking that short-term pivotal resistance that we highlighted yesterday at 1.2690 level. So what we could see over here is that there's this break of this descending channel, minor descending channel resistance that I drew from the high of 12th of June. And given the fact that this breakout of this descending channel indicates to us some form of short-term intraday bullish condition or bullish momentum condition has resurfaced back into the sterling dollar. So with that, the first support level to watch for sure will be the pullback line of the symmetric of the former descending channel resistance, now turns into a pullback support at 12650 level. So I will use the 50-day moving average because yesterday the price managed to hit and bounce right off slightly above the 50-day moving average, okay, which is at 16220 level. Okay, so push it slightly higher. Okay, 16220 short-term pivotal support. So as long as this pullback didn't surpass below 1.2620, pardon me, about tongue twisting, I repeat again, as long as this potential minor pullback didn't surpass below 1.2620, that's our short-term pivotal support level, we will flip to a short-term intraday bullish bias. After 1.2690, the next resistance to watch will be also conferencing with the 20-day moving average at 1.2740, pardon me, 1.2740. Above it sees 1.28 figure next. Only an hourly close below 1.2620 will invalidate this short-term intraday bullish bias to expose the 200-day moving average that is also acting as a support level, confluencing at the graphical support level, which is the former minor swing high of 8th of May and 13th of May at 1.2565. Below 1.2565, risk a further, we call it a weakness to expose the next near-term support level at 1.2510 level over here. All right, so that's for the sterling dollar. So now going on forward, let us now move towards the Asia Pacific dollar pair, starting with the dollar yen first. All right, the dollar yen. So dollar yen, still recall yesterday we were neutral between 160 30 40 159 10. So 1630 16030 16040 is in fact the former minor swing high area of 29th of April that actually saw the most recent real FX intervention as instructed by MOF, the Japan Ministry of Finance, for the Bank of Japan to conduct by selling dollar and buying back the yen at that point in time. So I could see very interestingly, the price action now starts to hit the 15910 lower limit of that neutrality zone yesterday and managed to shape a bullish hammer candlestick. So it indicates to us that there's some form of support at the 15910 level. So for today, I'll be using the 15910 level as my short-term pivotal support level. Flip to a short-term intraday bullish bias to see at least a retest of that key resistance at 160.30/160 40 level. Only a breakdown below 15910, that means we have an hourly close below it, may expose the next support level at 15830/158 figure, and potentially a further drop could expose the 20-day moving average that is coming close, that is okay, which is this zone here. Okay, now the 20-day moving average. Okay, give me a minute. It's hang right now again. I don't know why. Okay, it's at 15 okay, this level here. Okay, 15730. Okay, let me remove this. Okay, 15730 level. Okay, so this is the key pivotal support level to watch for us to, in order for the dollar yen to maintain this potential short-term intraday bullish bias for a retest of the key resistance at 160.30/40. Okay, now moving on will be the Australia dollar. Okay, so for the Aussie dollar continues to be trapped within this sideways range configuration. Within this on the daily chart is very clear on this symmetrical triangle range that is in place since 13th of October and 3rd of February last year, and it's now trading very close to the upper limit of this symmetrical triangle range, with the key medium-term resistance coming in at 67.30, very clear over here. So on a very short-term basis, what we could see on the Australia dollar, we start to see there's some form of hesitance at this 66.75 short-term pivotal resistance that we highlighted yesterday. So we will still maintain that short-term intraday bearish bias within this medium-term range configuration that is still trapped inside it. The first support level to watch in on the intraday basis will be at 66.30. So this level is where last Friday's swing low. Right, only a break below this level exposes 66.10, which also confluence with the right with this 50-day moving average acting as a support as well. Only an hourly close back above 66.75 when you see a spurt up or a squeeze up to retest the medium-term range resistance, which is the upper limit of that symmetrical triangle range that I highlighted on the daily chart, 67.10/67.30. Okay, so that's for the Aussie dollar. So with that, let us now move on to the short-term intraday technical outlook on the major stock indices, starting with the Asia Pacific indices first. on the Japan 225. So the Japan 225 finally managed to broke out above the 20-day moving average again, and now piercing up towards the upper limit of this complex range configuration that is in place since the low of 19th of April. So the upper limit is at 39,500. That has been capping it since 15th of April this year. Okay, so with that, right, given the spurt up on a very clear higher low that's been seen over here, so with that, this will be removed. Okay, so with that, I will have a Titan key short-term pivotal support level for today at 38,720, which is the 20-day moving average right now. That is, I think, as a support level. Okay, let me copy this. 38,720. Okay, let me tidy up. So this will be a next support level to watch, which is the 50-day moving average. Okay, so today's key support level to watch will be at this 38,720. So as long as this level holds, potentially the next resistance for it to actually seek a retest will be at 39,290, followed by 39,500, which is a key range, medium-term range resistance highlighted earlier. Only a breakdown below 38,720 will see it another round of choppy decline to let it float down towards the lower limit of this complex range configuration, with the next support level to watch at the 50-day moving average at 38,460. If this level gives way, exposes 38,240 / 37,960 next. Okay, so that's for the Japan 225. Now, Hang Seng Index, or the Hong Kong 33, still remains weak. Why? Because of this ongoing trade tension with not even US, now it's G7 and China. G7 airlines and China, I would say. So price action managed to shape that bearish reaction of that 18,300 20-day moving average again. All right. And what we could see over here is that we start to see a series of lower high as well on the hourly RSI. So with that, I'll be using 18,300 as my short-term pivotal resistance for today. It's a very clear level where the yesterday's bounce was rejected again during today's Asia session. So as long as this level didn't surpass, there could be still some form of weakness, at least on a short-term basis for the Hong Kong 33. A breakdown below 18,070 today re-exposes last Friday, last week swing low area, which was tested on Monday as well at 17,800. All right, at least 17,780. Okay, 17,780, 17,800. Only hourly close above 18,300 will see a much more short-term minor recovery to unfold, retesting the 19th of June minor swing high area at 18,450. Above it exposes the next near-term resistance at 18,730. So what's 18,730 is the minor swing high of 5th of June. And if we do the Fibo retracement of this ongoing corrective decline from 17th of May all the way down to the low of this 17,780, it corresponds to the 50% Fibo retracement as well. Okay, so that's for the Hong Kong 33. Moving on will be the European indices, the German 30 or the German DAX. So very interesting, the German DAX also managed to squeeze up and got rejected right at the 20-day moving average that is acting as a resistance as well. So if we do the Fibo retracement of this last sell off or push down from 6th of June all the way down to the low of 14th of June, it also corresponds to close to the 50% Fibo retracement. All right, over here. So with that, this 18,380 will be my short-term pivotal resistance for today, and price action based on yesterday's US session, it managed to reintegrate back below 18,240 level. Okay, so as long as 18,380 didn't surpass to the upside, there could be still some form of weakness that may come into the German 30 over here. So the first support level to watch will be yesterday's okay, give me this level. Okay, last Friday minor swing low, which also correspond to yesterday's low swing low area as well at 18,110 level. So a breakdown below 18,110 level may revisit 17,990 / 17,930 next. Okay, However, an hourly close above 18,380 will invalidate today's intraday bearish bias to see the continuation of this minor corrective mean reversion rebound scenario to unfold, to actually seek a retest of the next resistance at 18,520, 18,640 slash 18,685 next, which is corresponding to the descending trend line that is still in place since the all-time high area of 16th of May. So that's for the German 30. So now, like I explained earlier, the US major stock indices, we see the outperformance on the Dow Jones Industrial Average at my start of today's daily dose due to the outperformance of the US financial stocks. So what we could see over here is that the Wall Street 30 yesterday broke above our short-term pivotal resistance at 18,390. It broke above this level, and it now starts to be evolving within this minor ascending channel that I drew from the low of 14th of June. All right, so what you could see over here is that yesterday price action hit the overbought zone before exiting again from the overbought zone. But while hitting the overbought zone, there is no clear signs of a bullish exhaustion or a emergence of a bearish condition, I would say, because the hourly RSI managed to shape a higher high. There's no bearish divergence at all. So with that, yes, it hit the next resistance at 39,600, which also corresponds to the upper limit of this minor ascending channel. There could be some form of a minor pullback taking shape today. So the first minor pullback support level to watch out for will be for sure this level here at 39,310 level, and slightly below it will be the lower limit of this minor ascending channel at 39,090 next. All right, 39,090 next. Okay, over here we also confluence with the former minor swing high very clearly of 7th of June and 12th of June that turns into a pullback support right now. So as long as this minor pullback didn't surpass below 39,090 for today, we will flip to a short-term intraday bullish bias on the US Wall Street 30. Next resistance to watch after 39,600 will be 39,790 and 39,900, which confluence with this cluster of minor congestion area over here in the past, 22nd of May and 21st of May, and also the 2-time Fibo extension taken from the low of 14th of June, project to the swing high of 18th of June and push it down to the 18th of June minus swing low. This gives you 2 times as well at 39,900 level. Only hourly close below 39,090 will invalidate today's intraday bullish bias on the Dow Jones Industrial Average, i.e. the US Wall Street 30, to revisit the 20-day and the 50-day moving average, acting as a support level at 38,730 level. A breakdown below it may see 38,560 slash 38,420, which will confluence with the ascending trendline support that I drew from 30th of May. Okay, so now Nasdaq 100. So I explained Nasdaq 100 continues to remain weak. Why? Because of one of its key component stock of NVIDIA. So now, in order to understand Nasdaq 100, we also need to look at NVIDIA. Why? Because it has a significant price action influence in the Nasdaq 100, given that it's a leader of the current AI play, and the AI team play is very much heavily concentrated on the Nasdaq 100 as well. So it's good for us to actually take a look at the price action on the Nasdaq, on the NVIDIA, which I did yesterday, that managed to decipher the break of that key short-term support of the 19,700 on the Nasdaq 100. So if you look at the NVIDIA price configuration on the daily RSI, it starts to now work out from the overbought level and it's now back towards the close to the middle of the RSI. Okay, close to the 50% level. So what you could see over here is that there's a bit more room to go down before hitting a current support area, okay, at around the 36 level. All right, on the 36 level, or if you could do also a ascending trendline support. Okay, is all at around the 36.5 level as well. So indicating to us that there is still some signs of movement more to go before the daily RSI managed to find some support area at the 36.5 level. So if we were to translate it in price action, NVIDIA may see the next support level coming in at the 50-day moving average, which is the bunch of support area over here. Okay, the gap, the upper gap at 105.50 and the lower gap at 95.10, which is our short-term, medium-term pivotal support level. All right. So given the break of that 20-day moving average yesterday, potentially this is the next support zone to watch out for. And given the fact that if you do the Fibo retracement of that last steep swing move up from 19th of April all the way to the all-time high of 20th of June, that actually also confluence with the 50% Fibo retracement and the golden ratio of 61.8, which is right exactly at 95.10. All right, that's short-term pivotal support that we highlighted earlier. Okay, so given this potential next support zone, there's still some more space to go. That means, i.e., at least in the short term, it may translate to further potential weakness on the Nasdaq 100. So that being said, on the Nasdaq 100, back to the short-term technical outlook on Nasdaq 100, it actually broke below 19,700 yesterday and hit the next support at 19,480. And right now, the RSI is now shaping a bounce off the oversold region. So given the fact that there could be a bit of pullback rebound taking shape for today, so I'll be using 19,730 as my short-term tighten short-term pivotal resistance for today, which is this former swing low area here now turns into a pullback resistance. So as long as this pullback rebound didn't surpass above 19,730, we'll still maintain that short-term intraday bearish bias on the Nasdaq 100 to shape that mean reversion decline to expose 19,240 next, which is the rising 20-day moving average as well. Only an hourly close above 19,730 will invalidate today's short-term intraday bearish bias on the Nasdaq 100 to see a kind of a recovery to expose the next near-term resistance in first step at 19,840, followed by 19,990 on the intraday basis. Okay, so that sums up for the major stock indices. So I would say that on the short term, intraday bearish, technical outlook is rather a mixed bag right now, and also given the potential, we call it rebalancing flows as well as we head towards end month and end of Q2. Right, so now let us now move on to the commodities market, starting with gold XAU/USD. So gold XAU/USD, for those who recall, on last Friday we flipped to a bearish bias. So price action yesterday, yes, it did a bounce as expected, but didn't surpass 22,345 and also managed to get rejected right at the 20-day moving average, acting as a first resistance at around 2,330. So still no change, still using 2,345 short-term pivotal resistance, also conversing with the 50-day moving average acting as resistance as well. We'll still maintain that short-term intraday bearish bias on gold XAU/USD. First support level to watch will be at 2,308, which is the minor ascending trend line that I drew from the low of 7th of June. 7th of June. A breakdown below 2,308 exposes the next support area at 2,280, 2,270 next, which is over here, the minor swing low of 1st of May and 3rd of May, and the minor swing low of 4th of April. All right, only an hourly close above 3,045, 2,345, pardon me, 2,345 will invalidate today's short-term intraday bearish bias to potentially see a squeeze up for a retest of last Friday's minor swing high at 2,365. We also correspond to the upper limit of this minor descending channel that I drew from the high of 20th of May that is in play right now. Above 2,365, potentially seek a retest of the 7th of June minor swing high. So this minor June swing high was actually triggered down the sell-off led by that China FX reserve data that indicate China did not purchase any gold for the month of May. So that is a resistance level at 2,386. Now, moving on, lastly will be the West Texas crude oil, WTI crude. So WTI crude still continues to play around the 81.90, 82.20 short-term pivotal resistance that we highlighted yesterday. So price action indeed hit the first support and bounce off at 80.60, which was close to last Friday minor swing low. Price action on the RSI continues to remain lackluster, tracing a series of lower high, as you could see by this descending red line here. So with that, still no change, 82.20, 81.90, 82.20 short-term pivotal resistance. If this level continues to hold and not surpass the upside, there could be still a chance of a minor pullback on West Texas oil. Still remains that bearish bias on West Texas oil. First support it got to break will be at 80.60. break below 80.60, potentially see a much more deeper minor corrective pullback scenario to play out to expose the next near-term support area at 79.45/78.90. We saw confluence with the 50-day and the 200-day moving average acting as support as well. Only a breakout above 82.20 will invalidate today's short-term intraday bearish bias to see the continuation of this recovery for next near-term resistance to come in at 82.90, followed by 84.40 next, which is the minor swing high area of 29th of January and the one-time Fibo extension from the low of 4th of June. Okay, so that sum up today's short-term intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the economic calendar of what are the key data to look out for today. All right, so today will be a rather quiet session. For those who are trading maybe the Canada dollar, do take a look at this key economic data out from Canada, which is the Canada inflation rate out at 8:30 p.m. Singapore time. Then thereafter, we do have some housing data out from US at 9 p.m. The S&P Case-Shiller House Price Index for the month of April at 9 p.m. Pardon me. And we do have the Conference Board Consumer Confidence data out at 10 p.m. Singapore time. Then thereafter will be a rather quiet session, and at 12 a.m. we do have a slew of Federal Reserve officials speaking. Fed Cook will be speaking. Then thereafter, 2:10 a.m. Singapore time, Fed Bowman will be speaking. All right, so that should sum up for today's daily dose of market insight. Yeah, before we go, before the start of tomorrow's daily dose at 9:30 a.m. Singapore time, we do have an important Australia data out, which is the monthly CPI Australia indicator. Market is expecting a further uptick to 3.8% year-on-year from 3.6%. All right, so with that, I wish you all a great day ahead. This is Kelvin here signing off, and we shall speak again tomorrow. Thank you.